Most traders understand the basics of price action, but the skill in reading price action is when you can combine it with higher time frame context. If you can get these two things right, you don't need any indicators on your chart. You can simply wait for price action to align with higher time frame context to get into high probability trades like this 3R plus long on AUD USD. I'm going to show you what to look for. So the first thing to look for is what is happening in the exact area of price that you're analyzing. So we can see right here that we have a downtrend, which means that we have swing highs being respected and we're trading through swing lows. So we've traded through this area and created a bearish price leg. Price then, instead of respecting the internal range liquidity here, creates a bullish price leg. In doing so, creates an imbalance in price. We retrace in and then we trade away. So let's look at the mechanics of price action first and foremost. So in this specific price leg, we have the order block at the high, the last buy candle before the sell, and then we have various fair value gaps. So there's one small one there, then we have this fair value gap right here. I'll mark that red to show that it's actually a bearish fair value gap. And what you'd expect to see really if price was going to stay bearish is that these areas would be somewhat respected, but they just get traded into with candle closures. So it's aggressive price action. Then what we get in reverse is a bullish price leg. So we have the formation of a bullish order block, the formation of bullish fair value gaps being created right here. Price trades in and trades away. But the skill here is not just mapping the path of price and the areas of internal range liquidity, it's understanding where we are in terms of the higher time frame. So what I'm going to do is just overlay the monthly candle. So I'm on the 12-hour here. I'm going to overlay the monthly candle. What we can see is when price closes right here, we create a bearish monthly candle. So this entire range of price action right here is a bearish monthly candle. So I'll mark that in red. So at this point here, when price is retracing, we're raiding the liquidity at the low of the previous monthly price range right here. So I'll mark that in green so that we can see it. So price trades into the low, then we get a shift. So we have price action coming off a key area of external range liquidity. So we can now be confident that we can place a trade from the fair value gap itself, either cover the fair value gap or potentially the inverse fair value gap to long back to this high and eventually potentially this high. Because as soon as we get a close of this middle monthly candle, this candle has manipulated below this candle's range and closed inside. So the logical path for price is to then draw to the external range liquidity at this candle's high. However, we can also use intermediate time frames to get even more accuracy. So if I look at the 2-week time frame, we can see that this specific 2-week price action manipulated below the previous candle's low right here. So I'll mark that in green as well. And we can see it's closing inside that candle's range. So actually the first target for price is the 2-week high that's been manipulated, and that plays out for a 2.89R trade. If you want to hold that further, you've got a 4.56R trade. That is covering quite a conservative area within your stop. You could even move this up to just cover the liquidation of this 2-week candle. Then you have a 4R trade to the 2-week high and a 6R trade to the monthly high that has been manipulated. So what we're doing is combining price action with higher time frame context to get into much stronger swing positions. So let's just look at a little bit of theory, then we'll check out another example. So price action is just reading candlestick movement without indicators. It's understanding what is happening. Are we bullish or are we bearish? But we're doing it in context of higher time frames. And we can look at things like candle wicks and body closes to look at commitment versus rejection of key levels. What most traders do is they just trade price action. They look for fair value gaps, order blocks, whatever it might be, breaker blocks, without higher time frame context. They just enter on these candles or these areas of liquidity and hope for the best. Price action alone is not enough. You'll see so many examples where price action just doesn't get respected. It's about combining it with the higher time frames. So let's look at Bitcoin USD, and I want to actually look at this area here, which is all-time high. So the all-time high for Bitcoin was always going to be an interesting area because it aligned with this monthly candles high. So what happened is that we manipulated below right here this candle's range, and then price traded to the external range liquidity at this high. So we have an interesting area that we can track price from. Then what we want to do is just look at price action and see if there's a story that we can create to get into a long or a short entry. So what happens is that price is very aggressive, moving in to all-time high. It's generating max FOMO. People are thinking Bitcoin's going to just run forever. We trade into this fair value gap. Price pushes up. We retrace. Price pushes up again. This is literally peak FOMO right here. Then we get a dump. So price sells off. And at this point here, we get a structure shift. So we have a swing point at this low here. And we're just looking at price action now. We get the creation of a bearish price leg from the swing high to the swing low. We get the creation with this blue candle here, this last up candle, of a bearish 12-hour order block. And then we also get the creation between candle 1 and candle 3 of a bearish fair value gap. So we now have an interesting dynamic where we have price action shifting from bullish to bearish with internal range liquidity at a key level. So it wouldn't be a bad idea to just short this from the fair value gap, covering the high or covering the liquidation, and you see the sell-off has been extreme. So obviously, we're not saying, or I'm not saying that you'll hold this for a 15-hour target, but you could at least hold this for a 2-hour, 3-hour, and then as price develops, you just hold the trade and scale it down. And this is the power of combining higher time frame context with price action. This is how you get into really high probability swing trades that play out for the long term. So let's take a look at how to actually apply this. So first things first, establish your higher time frame bias. So always use the higher time frames to actually get a read on where you think price is going to head next. Then wait for price to liquidate key areas of external range liquidity and read the price action that occurs at those key levels. Confirm that new price legs are being created on your execution time frame through the creation of internal range liquidity. Then enter when your higher time frame and your price action align. So my model is I'm doing this for over 32 Forex pairs, including gold, silver, Bitcoin, and I'm tracking 12-hour price action in conjunction with monthly, 2-weekly, and weekly closes. And then I just execute. And when you get good at this, you can do it in 10, 15 minutes a day, and then just get on with your day. So if you want more content like this, please subscribe. I have videos on internal range liquidity, on higher time frame bias, on candle range theory. So there's a lot to unpack, and I'll see you on the next one.